Morningstar has just released an investment outlook for 2023, and Morningstar's Global Chief Investment Officer, Dan Kemp, is here to give us a heads up of what to keep in mind when we try to navigate the market in the new year. Dan, from this 2023 outlook, is there anything that stands out from previous years?
Well, John, I think the first thing that stands out is that we think about outlooks a little bit differently from other people. We believe that the future is uncertain and therefore unpredictable. And so we don't spend our time trying to forecast what's going to happen in the year ahead. Instead, we think about the investor and how they navigate whatever 2023 has ahead for us. And so we always start thinking about investment from the investor perspective. We've done that with this outlook as well, that it's geared around the challenges that investors face as they think about 2023, the challenges posed by markets, and even the challenges posed by different life stages in terms of their investment. So this is far more an outlook for the investor than it is an outlook for the markets. The other thing that's changed, of course, is the investment landscape as we enter 23 is different from that which we entered in 22. And so that marks a change as well.
Okay, so it's more up to the investor than to not forecast the future, but rather to construct a solid portfolio, really, to help us reach our long-term goals. But I do, however, think that a lot of investors might have been a bit disappointed with some classic portfolio structures like the 60-40 during 2022. Do you think that these old theories of diversification will still hold in the future?
That's a really, really good question. And as we think about 22, you're absolutely right that it was a real surprise for a lot of people because not only did we have share prices falling, and that happens frequently, particularly when we have big global macroeconomic shocks like the war in Ukraine, but also bond prices fell as well. And people typically rely on the price movement of bonds to offset that of shares because they normally move in opposite directions. And so if you hold both shares and bonds in your portfolio, then one is designed to offset the other, and that may give you a smoother ride as an investor. That didn't happen in 22, but it usually does happen. If you own high quality bonds, then typically that's the best insurance policy if you want to protect a portfolio against these periods of market volatility. Now, there's been times in the past where it hasn't happened as well. So there was an event called the taper tantrum in 2013. There's a period in 1994, and then there's a period in the early 70s when, again, we had this synchronized downturn in equities and bonds. But the fact that we can highlight those three areas in the last 50 years is a real reminder that normally bonds do their job. And there's no reason to expect the bonds won't do their job in the future. The key is to understand the value of these assets, that when prices are really high, then they're less likely to be supportive of future returns. The benefit for investors as we enter 23 is that prices are lower than they were as we came into 22.
Okay, so diversification is not out of fashion then. But for those investors that might still feel a bit worried about this ever so quickly market and all these changes, what advice would you like to give to them?
Yes, well, the first thing to remember, and as I mentioned it at the beginning of our conversation, that the future is uncertain. And the definition of uncertainty is that we not only don't know what the outcome will be, but we don't know the range of possible outcomes. So uncertainty is different from risk. When we think about risk, we can think of that like rolling a dice. You don't know what number will come up when you roll a dice, but you know it'll be somewhere between 1 and 6. And you can work out the probability. Whereas when we're thinking about the future, when we're thinking about investment, then the future is uncertain. And we all feel really uncomfortable about that uncertainty. And so the danger is that we transform that uncertainty into stories, into narratives that then drive our behavior. And when we try and create narratives about the future, then we normally make mistakes. So we can become too aggressive in our investing when prices are high, and too defensive, too depressed about the investing conditions when prices are really low. And that tends to be supported by the news flow that we see around us, and the announcements, and the positive and negative sentiment of other investors. So the most important thing as an investor is to try and protect yourself, insulate yourself from all of that news and noise around us, and remember that when prices are low, that's a better time to invest.
And on that note, thank you so much, Dan, for sharing your thoughts. And until next time, I'm Johanna Englundh for Morningstar.